consumer protection laws. So we have two laws, and both of these laws are regulated under the Consumer Financial Protection Bureau, the CFPB. And the first law we're going to talk about is the Truth in Lending Act. Now, sometimes real estate students get a little bit confused between the two laws we're going to talk about. We're going to talk about Truth in Lending Act. We're also going to talk about RESPA, the Real Estate Settlement Procedures Act. Truth in Lending Act is not real estate specific. Truth in Lending Act, known as TILA, is not real estate specific. It applies to all loans. So, if you're driving down the street, driving home tonight, whatever you're going to be doing, and you hear a loan for, let's say, a car for sale, and they give you monthly payments. They say low monthly payments, or this is the interest rate, or something like that. What happens is then you hear the fella or the woman talking very fast at the end of the ad. See lender for details. That's the disclosure they're doing because of the Truth in Lending Act, right? So it talks about all loans and it requires disclosures. So the understanding is, the intent is that the consumer understands all the costs associated with getting the loans. RESPA, the Real Estate Settlement Procedures Act, is real estate specific. TILA, the Truth in Lending Act, is not real estate specific. It's all loans. That's a big point. Now, we're going to be talking about this shortly, but I want you to do something. What I want you to do is take out a pencil and right next to TILA in your workbook, write Reg Z. Reg Z. Do it now. All right, get a pen and write down Reg Z. That stands for Regulation Z. TILA is the law that was passed, the Truth in Lending Act. Reg Z was the regulation that put it into play. So you might see everything that's talked about under TILA referred to as Reg Z. So for our purposes, they're the same thing. Truth in Lending Act, Reg Z. You'll see more of this shortly. So, Truth in Lending Act, disclosure of all loan costs, covers all consumer lending, not just real estate. It requires disclosure of something called the annual percentage, which reflects the true costs and lender charges of getting a loan. The annual percentage rate will always be higher than the interest rate on the loan because it rolls in all the costs of getting the loan. The other law is real estate specific. Real Estate Settlement Procedures Act makes the lenders disclose all closing costs. And this covers real estate professionals, agents, lenders, title companies, and closers. Real Estate Settlement Procedures Act, RESPA. RESPA, Real Estate Settlement Procedures Act, standardizes closing practice for 1 to 4 family residential properties. So it's real estate specific and it's only residential real estate specific, only 1 to 4 properties. And it's any property that's purchased with the loan which is financed by a federally related lender. And think of it this way. If the loan comes from a federally regulated lender, so it's not just FHA, it's not just VA, it's also insured, conventional, and conventional. If the loan comes from a federally regulated lender, then RESPA must be met. So it applies to all those loans. What's not on that list? Seller finance not on that list. The idea is RESPA ensures that buyers and sellers receive information of all settlement costs, not just about the loan. This includes the down payment, any appraisal fees, commissions, anything that are expenses that relate to the closing are meant to be disclosed to the buyers and the sellers. All right. Also requires an estimate of loan cost at the time of application and disclosure of all the loan costs, like a redisclosure of all the loan costs at closing. So RESPA requires all of these disclosures, the idea being at the bottom of the RESPA disclosure, here's how much money we're estimating you're going to have to bring to closing. That's your down payment plus all loan costs plus all other associated, the appraisal, et cetera, home inspection, whatever it might be. Okay? RESPA, all costs associated with buying the property. Truth in Lending Act, just the costs associated with getting the loan. Truth in Lending Act applies to all loans. Real Estate Settlement Procedures Act only applies to residential properties 1 to 4 units. Now, RESPA prohibits kickbacks to real estate agents for referral of any closing-related services. Now, here's the thing. Real estate, how can I say this and not, get you disappointed? Real estate industry has had its share of scoundrels. People don't buy a home very often. Maybe once back in the day, once in their lifetime. Maybe twice in their lifetime. Nowadays, maybe more often. But it's still not something that happens very often. It's complicated, and it was easy to hide money. All right? The whole idea behind the Real Estate Settlement Procedures Act was to prohibit any undisclosed, under-the-table money being changed hands. Real estate agent says, use that title company, they're the best. They're the best. Well, they're a little bit more expensive. Yeah, but you should use that title company. In fact, it's the only title company you can use. You got to use that title company. Okay, I guess I'll pay the freight. Title company goes, hey, let me crease your palm with silver. Thanks for the referral. And the person who paid for everything is unaware. That's what this prohibits. Prohibits kickbacks to real estate agents for referral of any service related to the closing. And it's not just closing services. For any service related to closing. Talk to your broker about how your company is going to go about making sure that all that has to be disclosed is being disclosed. So the Real Estate Settlement Procedures Act also restricts lenders on how much they can escrow, make you to pay up front. So let's say you're getting a PITI loan, principal, interest, taxes, and insurance. And the lender says, we want you to pay 10 years of taxes up front. We want you to pay 10 years up front. They can't do it. All right, that's the idea. They're going to be limited. And it's something like 1/2 the amount owned over the year or something like that. But RESPA restricts consumer protection law. Even to this day, and I can think of some of these that have happened within the last decade in my marketplace. And you'll hear of a RESPA violation that was done. And they're often done by large companies. Something might come up where, people had a small little loan fee that they had in there, and maybe it wasn't disclosed properly. Something like that can be a RESPA violation. Here's my advice to you. Do not run afoul of RESPA. All right? RESPA violations are one of those things that won't just bring down an agent. It could bring down your entire company. Okay, so you want to make sure, hopefully your company has compliance procedures. The closing companies have compliance procedures. The title companies have compliance procedures that makes sure that all the proper disclosures are being made. Okay? Sometimes real estate agents fall into this without really even thinking about it. They receive a referral fee for referring a painter. And all of a sudden, boom, we might have a RESPA violation because the buyer didn't know about the referral fee. They could have picked any painter. They took the one you recommended. So talk to your broker about making sure we're doing business that's going to be in compliance with RESPA, the Real Estate Settlement Procedures Act. Truth in Lending Act, TILA, Federal Reserve Act, Regulation Z. Now, I want you to do this. I want you to highlight Truth in Lending Act, TILA, and I want you to keep highlighting Federal Reserve Regulation Z. If nothing else, now come back and circle Reg Z. Circle TILA and put an equal sign. Same thing as far as you're concerned. All right, so if you're taking a test, the test question might say, according to Regulation Z, and then they ask a question. Or according to the Truth in Lending Act, and they ask a question. As far as you're concerned, they're the same thing. That's an important point. So star that, highlight that, what I just told you. Understand that Truth in Lending Act and Reg Z, for our purposes, are the same thing. Now, the Truth in Lending Act is not real estate specific. The Truth in Lending Act covers all loans. What's its purpose? Like this. The purpose is to promote informed use of consumer credit. Informed use of consumer credit. How do they do it? They require advanced disclosures of loan terms and costs. All right, so you got to know what you're getting into. Regulation Z, informed use of consumer credit. How do they do it? By disclosure of loan terms and costs. Once again, this is why you hear the person talking fast at the end of a radio ad that talks about financing something. 0% financing. Buy the car for only $399 a month. For details. All right? Regulation Z is doing that. Truth in Lending Act is doing that. 4 primary disclosures required of lenders. One is the true cost of credit. Now, to make it easy, it's expressed as an APR, the percentage rate. Now, here's how this works. Let me just click on it and I'll show you something. The APR, or the effective rate, is the actual cost of obtaining the loan expressed as an annual percentage rate. So let's say I got my old financial calculator here and I say, okay, I'm gonna write a loan to you, make a loan to you for $100 grand. I'm gonna charge you 5% interest rate. Oh, I'm gonna charge you a loan origination fee, 1 point. Oh, I'm gonna charge you a discount point up front. Oh, I'm gonna charge you a little maintenance fee here and there. Bing, bang, boom. And then I'm gonna hit, just for my purposes, the lender says, I'm going to calculate my actual yield on this loan, because they're going to pay me not just interest rate, they're giving me money up front. So it might say 5% interest rate, but I'm actually making 5.15%. So it shows up. That's your annual percentage rate. That's the effective rate. That's really what I'm making off this deal. My yield is higher than your interest rate, because I'm going to roll in all these costs that you're paying up front. All right, so if I lend you $100,000 and I charge 5% interest, my yield's 5%. If I lend you $100,000 and you give me $1,000, and then I charge you 5% on the hundo, you pay back, I make more than 5%. That's what this APR thing is. It's an effective rate. If you live in a cold climate like I do, it's kind of like the wind chill. Yeah, the temperature is 20 degrees, but it feels like 10. APR is kind of the feels like factor. It's the heat index. Your interest rate's 5%, but it's going to feel more like 5.1% when it's all said and done. Something like that. Think of it that way. The APR will always be higher than the face rate or the nominal interest rate. It's going to be interest plus. So annual percentage rate, APR, you need to know that. Annual percentage rate, APR, effective rate, APR, effective rate. Highlight letter A there. APR, effective rate. So total finances charges associated with the loan include the interest rate, origination points, points paid for origination fees, assumption fees if you're doing that, borrower paid points, discount points, mortgage insurance costs, all those things rolled into one. And now your loan is going to be bigger, and the bigger loan, the payments you're making on the loan, the money up front you're making, are actually going to be more feel like this percentage rate, the APR, the effective rate of the loan. So the total number of payments and the amount of all payments must be disclosed by the lender. So let's back up. So they have to disclose the APR. They have to disclose all the finance charges, including all this stuff. All right? Interest rate, origination, assumption fees, borrower paid points, mortgage interest costs, etc. That's the second thing they have to disclose according to Truth in Lending Act. Third, they have to disclose the total number of payments you're going to make. 30-year loan, 360 payments. And when it's all said and done, this thing's a shocker. When you make all those payments, here's what it all tallies up to. You got your $200,000 loan, you're going to pay us back $670,000 or something like that over the time period. All that principal plus all that interest over 30 years. That's got to be disclosed. The total amount financed must also be disclosed by the lender. You're financing this much, $100,000 loan, plus we're financing the points, so it's a $102,000 loan. So those are the four things. The APR, all of the costs, total number of payments and the total amount to be paid over the life of the whole thing, and the exact amount that you're financing. All this must be disclosed by the lender under Regulation Z. So it applies to all consumer loans, including mortgages. It does not apply to kind of business loans, loans made to entities like corporations, business or commercial loans, and seller financing. All right? It does not apply to seller financing, contract for deed or purchase money mortgage either. One of the key things about TILA is it requires a 3-day right of rescission. Now, this doesn't apply to most of the people you're going to be doing business with. All right? The 3-day right of rescission would apply for refinances. It would apply for home equity loans, second mortgages. It would apply to getting a roof replacement financed. You buy windows and they offer financing, it would apply to that, but it doesn't apply to home purchase or construction loans. All right, it excludes that. So this portion, this 3-day right of rescission, does not apply to most of your customers. Still something you need to know. Look, 2 stars. TILA, 3-day right of rescission for refinances, home equity loans, and all other credit transactions. Does not apply to home mortgages, home mortgage loans, or construction loans. 2 stars, 2 things to highlight. Advertising requirements. The only thing you can highlight without full disclosure, the only thing you can advertise without full disclosure, I'm going to tell you to highlight price and APR. Those are the only 2 things you can advertise without making full disclosure and having the person talk fast at the end of the ad. You can advertise price, you can advertise APR. If you mention the down payment, highlight this. You mention the down payment, the interest rate, the monthly payment, the number of payments. This triggers full disclosure. That's the fine print. That's the guy talking fast at the end of the radio ad. So highlight price and APR are the only finance terms allowed. Highlight that mention of down payment, interest rates, monthly payments, etc. triggers full disclosure. You can use general statement like easy financing terms or low down payment. You can also state the amount of the property taxes or the homeowners association dues. That's not related to financing, so it doesn't apply. Here's an example of a couple of ads. All right, example ad 1, $150,000 price with an APR of 5.5%. Call for other great terms. By the way, the homeowners association fees are $50 a month. Taxes $1,200 a year. It's okay. No trigger. Example 2, $150,000 purchase price, 100% financing. Oh, payments of $675 a month. Oh, triggers full disclosure. I talked about down payment, 0 down. I talked about a monthly payment. Boom, this triggers full disclosure. So remember, Truth in Lending Act, disclosure of all loan costs. RESPA, disclosure of all costs to close. Relatively new kid on the block, TRID. This came into effect, I think it's October 2015. So relative to RESPA and relative to TILA, this is the new kid on the block. So the idea here is that in response to the loan crisis, in response to the financial crisis, to try to make disclosures more easy to understand was the goal here. TRID, which stands for the TILA RESPA Integrated Disclosure Act, TRID, TILA RESPA Integrated Disclosure. What it does is it takes the disclosures which were required under Truth in Lending Act and the disclosures required under RESPA and create one disclosure package. Okay? There is still a Truth in Lending Act. There is still a RESPA. So it didn't replace these laws. What it did is it combined the disclosure requirements So look at letter A. Combines the TILA RESPA requirements and shows both APR and lender costs and all estimated loan costs. This is called the loan estimate. They used to call it the good faith estimate. Now it's called a loan estimate. This is what it is. It's a loan estimate. All right, the LE. Information is presented to help consumers better understand the loan and closing costs. All the pertinent information is on the front page of this. I can't remember how many pages it is, disclosure. Let's say it's 3 or 4 pages or something. All the information is on the front page, so essentially if you went to 2 different lenders, you could look at the 2 front pages and see the different loan costs involved right there. So the loan estimate. It must be provided to the borrower no later than 3 business days after loan application. The lender must provide it to the borrower no later than 3 business days after loan application. And the consumer has to acknowledge receipt. The lender has to have acknowledgement that, in fact, this loan estimate was delivered. I want you to star this. Key point here is loan estimate must be delivered in 3 business days. Key point. The loan estimate, according to TRID, the loan estimate must be provided to the borrower within 3 business days of the loan application or after the loan application. And the consumer must acknowledge receipt. Now the same law then requires a closing disclosure. The closing disclosure, the CD. The closing disclosure must be provided to the borrower no later than 3 business days before closing. Loan estimate, 3 business days after loan application. Closing disclosure, 3 business days before closing. Lender must have an acknowledgement of receipt. The nice thing about this is I think these are both very important things, but the nice thing is they're both 3 business days. How many days does the lender have to give the borrower a loan estimate after loan application? Answer, 3 business days. How many days does the closer have to provide how many days does the lender have to provide the closing disclosure to a borrower? 3 business days prior to closing. 3 business days prior to closing. You might think that this doesn't apply to you. Wrong. You're going to be one that's going to say, hey, where's my loan estimate? My buyer needs the loan estimate. Let's go, chop, chop. Same thing with that closing disclosure. I don't want this closing to blow up, man. I want to see that closing disclosure. Let's go. You got it? I want to get it over to the buyer. I know you got 3. Get it over there today. Come on. Let's move this deal forward. Maybe you're not a jerk like I am, but the point being is it's your job to ramrod this thing closed. And you know your buyer's got to get these disclosures and you're going to make sure they get them. If certain changes are made to the loan, so there's a difference between the loan estimate and the closing disclosure, it automatically triggers a delay. All right, so TRID potentially increases the odds that you're going to have a delayed closing. But these are pretty big changes. The changes that will trigger a delay in a transaction are as followed. The APR increases. All right, but it has to increase over a certain threshold. 1/8% on fixed rate loans or 1/4% on variable loans. I'm not worried about those percentages, but you can see they're relatively small, but not really in interest rate world. Okay, so it can change, but it's got to change within limits. If the interest rate goes up over 1/8% on a fixed rate loan, boom, done, we're not going to close. Automatically triggers a new 3-day window. Addition of a prepayment penalty from loan estimate to closing disclosure. Boom! Automatically triggers another 3-day window. A change in the basic loan product. Bang! Automatically triggers a new 3-day window. We're not going to close. That might be something like changing fixed rate to an adjustable rate. I mean, that's just bad business. That's bad dealing. But those three big changes would delay your closing. Other last-minute changes to the closing disclosure generally will not require a new review period. So things can happen those last final days, and it doesn't necessarily mean you're going to have a delayed closing. Real estate agents hate delayed closings. Let me tell you, so do the buyers, so do the sellers. Everybody gets worked up. We're going to close, we're going to close. Oh, we're not going to close. Darn it. The lender is responsible for timely delivery of both the loan estimate and the closing disclosure. It's the lender's responsibility to get these things to the consumer. And TILA, RESPA, and TRID apply to federally related loans. In the case of RESPA, TRID, it applies to federally related residential mortgage loans. Federally related generally means the loans are coming from a federally regulated lender. So some exceptions: home equity lines of credit, mobile home loans, reverse mortgages, seller financing does not come under the regulation of TRID. Another consumer protection law, this one actually kind of gets into civil rights a little bit. The Equal Credit Opportunity Act. All right, what this act is for, the purpose of ECOA, the Equal Credit Opportunity Act, is to make consumer credit available with fairness and impartiality. A person's race, religion, color, sex shouldn't have any bearing on whether they qualify for a loan or not. All right, so this came after the Fair Housing Act. There's a Fair Housing Act in 1968. And the Fair Housing Act said on a federal level, you can't deny housing to somebody based upon their race, religion, color, sex, national origin. Familial status and handicap disability were added later. I think it was maybe the 1990s or something like that. In other words, you couldn't deny housing to folks based upon race, religion, color, sex, national origin, etc. Yeah, but try to get a loan, you see. And so around the early 1970s, the Equal Credit Opportunity Act was passed and said you can't deny credit to somebody based upon these protected categories. So it prohibits discrimination in consumer credit transactions. The protected categories include race, color, religion, national origin, sex, marital status, dependence on public assistance, and age. Highlight this, but really focus on age. ECOA says you cannot deny a loan to somebody based upon their age. I don't care if they're 85 years old and they show up for a 30-year mortgage. You cannot deny a loan for someone that other else qualifies on the basis of age, nor race, nor color, nor religion, nor national origin, nor sex. Now we've got marital status and dependence on public assistance highlighted here. That's because under the Fair Housing Act, those are not covered. So protected categories that the Equal Credit Opportunity Act adds to the Fair Housing Act: marital status, dependence on public assistance, that's income. It's a legal source of income. The lenders have to take it into consideration. And age, with age being the one I want you to circle. All right, so highlight number one here. Race, color, religion, national origin, specific attention to marital status, dependence on public assistance, and age. So ECOA adds the protected classes of marital status, age, public assistance. Maybe the acronym MAP helps you out. Look at that, I had you highlight it, and now I want you to write it so you get the idea. ECOA adds the protected classes, marital status, age, public assistance, marital status, age, and public assistance. It's a lot to write in. You got it done? Marital status, age, public assistance. ECOA does not protect minors. You don't have to give a loan to a minor. They don't have contractual capacity. It does not protect families with children. Now, families with children is protected under the Fair Housing Act. But you can imagine that if a person makes $50,000 a year and they're single, compared to a person who's $50,000 a year, single parent with 4 kids, the person who's single with no kids can probably qualify for a loan easier than the single person, makes the same income, with more kids. So lenders can take into account families with children. Lenders are not required to lend to those with erratic employment history or bad credit. So lenders can consider credit score. What they can't consider are the protected categories that we've talked about. Also, part of the Equal Credit Opportunity Act, if you've ever been turned down for financing on something, and then usually it's several weeks later, you're going to get a letter from the lender saying, here's why we turned you down. Lenders are required to provide a written notice of why a borrower was denied credit.